Hello, Business 630 students. This is Professor Hassey speaking to you live and in color from Claremont, California. And this is our week number 2 lecture video for our Business 630 class, the week of August 30th to September 5th. And it's entitled Capital Valuation. And I apologize this week for being so late. I've had some technical issues with Zoom, with video, with my computer. Got everything finally all straightened out, and I'm preparing and producing this video. Today is Thursday, September 2nd of our week number 2, so I apologize for that. But this week, we're going to go back over some old topics that many of you have studied before, just to make sure we're up to speed and get prepped for our case number 1, which will be posted this coming Sunday, September 5th, and due on Sunday, September 12th. You have a week to do that, and it's going to be some work on our first few chapters or first few weeks here of our course. But our case materials and our case studies are designed to assess your information, to interpret and analyze data, and then give your own explanations for that. One problem that you'll have in this week will be to take the company that you've selected in your discussion forum for last week. We all selected a wide range of firms, and I'm looking forward to your analysis on this company throughout the semester or throughout the fall session. And you're going to be doing a risk analysis of your company. What is the company's beta? What is the company's credit rating? And doing some other work. So one of the case questions will be doing a credit analysis of the company that you've chosen, because in order for these companies to get capital, they have to have verified to the market that they're risk-free or somewhat risk-free and are able to be given capital and pay it back, or return an investment in as far as stock is concerned to their investors. So understanding a credit analysis of a real live company will be one of the facets of our assessment in these early weeks of our course. But before we get to case number 1, I just want to review in this video some key topics of the time value of money, debt valuation, and risk and return. And I've had some comments on the discussion forum in the past week about, Mr. Hassey, I'm scared of math, numbers freak me out. What are we going to do? Well, the good thing about this class is mainly we're still going to work with numbers, but we're going to use spreadsheets. We're going to use formulas in spreadsheets. You're going to be given templates of work. So your actual calculation of a lot of numbers is going to be rather limited in your understanding. And if math freaks you out, don't worry about that. We have templates and ways of doing that. The key part of this class, remember, is to analyze the data and what we do next. Corporate finance, understanding the strategies and critical thinking involved in finance. And that's the key part of this MBA course. We're also this week going to start selecting our teams for the electrics case. Now, the electrics case will be distributed next week or in the following weeks. And it is a paper to be done with a capital budget analysis of this company, Electrics Incorporated. It involves a review of the market that Electrics is in. It involves a review of the investment and the cost of capital, and then it involves an interpretation of all that data, answering a series of questions in the case. So we're going to split ourselves up into 10, we have 30 students, 3-person teams. So I'm giving you the opportunity this week in the discussion forum, if you feel like you'd like to work with a student in our class, maybe you've worked with this student before or developed a friendship or a camaraderie through Blackboard. If you'd like to work with somebody, clear it with them and post that to the discussion forum. We've already had one student indicate that she would like to work with somebody. I would take those suggestions. If you get those by this weekend, then over the weekend, I will start putting the teams together and post them by Sunday to Blackboard so you can review them. And if you don't like the teams that I set up, just let me know. And how I'm going to do it, if I don't get any suggestions from you, I'm just going to use a random generator application that I have to randomly go through of the 30 students and pick 10 3-student teams. So that's how I'm going to do it. So if you don't like it, you can let me know over the weekend when I post the teams. But you're going to be broken into teams mainly because we have limited time in an 8-week class to prepare for this. And also, it's a good assessment of your ability to work with others. So you're going to have 3 team members. One team member might work on the market sector of this problem. Another team member might work on the capital budget analysis. Another team member might work on answering the questions that the capital budget analysis prepares. So we'll sort that out of which team members do what. I would like a student to volunteer once the teams are set up to be like the team leader, team CEO, team manager, just so I can go through that one member instead of going through all the team members. But I'm going to set up each team with a Blackboard file. So each team will have a file to work with on their own and they can collaborate amongst themselves. So we're going to set this up over this weekend. So right now I'm taking any students in our class who we might be interested in working with other students. Then on Sunday, I'm going to put all this together and set up the teams and distribute it to you with my introduction video to week number 3, my introduction video to case number 1, and in that introduction video, we'll also talk about the teams for the electrics case. So a lot going on. Just pay attention and ask questions, and we should be in good shape. All right. So let's take a look at some things in our Blackboard. Okay, here's our Blackboard file folder, our Blackboard folder. Hope you're all beginning to get familiar with this and are visiting it to take a look at our work and our assignments. Here is our discussion forum. And right now it has a discussion forum of the setup for if you can want suggestions for teams, go to that week number 2 electrics case analysis paper team selections, create a folder and let me know what you might like, who you might like to work with for this project. You know, I'm going to be perfectly honest with you. I'm not a big fan of teamwork. I think sometimes some students do more than others in a team and I just don't like it. But due to a new type of calendar that we have in the MBA program where our classes are 8 weeks, we're going to, and I'm going to give you a case that is a lot of work, and to split that work up amongst 3 students is going to be easier for you. It's going to make it be a little bit better of a learning way of learning all those facets of this case. So that's how we're going to do it. We're going to try it out this term. You guys are kind of guinea pigs because this is the first of our 8-week class sessions. So you're the guinea pigs on this, but I think you're all going to be doing well. What I've seen so far in the class, a lot of you are engaged and want to participate and learn, and I think that's a good thing. So that's why we're doing this. So if any suggestions for team members, please let me know. And remember, as I post videos or introduction videos or links to course recordings, class recordings, they are located here in the Zoom and YouTube links area. And here's our notes for week number 2. Here's our lecture notes, which I'm going to talk about in just a minute. Here's a spreadsheet file talking about chapters 4, 5, 6, and 7. And 7 will go into next week because basically week 3 is chapter 7 about stocks. But here's my lecture notes and some spreadsheet file, which I'm going to highlight in my lecture today. Also, you know, I take the key points out of the chapters. Here's the PowerPoints to chapters 4 and 5. We had 6 last week. And here's a good video describing bonds and interest rates, which you might want to look at. And we're going to look at some other videos also in my lecture today. So that's where we stand and that's where we are. Remember to review. Last week, we talked about the risk and return. We talked about how risk plays a large part into investments and to find capital for a company. If a company has a lousy credit rating, they're going to have a tough time getting capital from banks or stockholders because it's just too risky for that company. It's too much of a risk for those people to give up their money. In another format, we're going to look at how risk determines the return on investment. The risk of an investment determines the cost of the investment, how much the person or the company that's getting the money has to pay back to their bondholders, to their bankers, to their shareholders, okay? If a company like Apple Computer has a lot of profits, they have low risk, they have low interest rates. And some of this has to do with the performance of the company, the reputation of the company, and also the management team of the company. And we'll take a look at this as time goes on. Remember, assets create revenue, which create profit, which create cash flow. The key part of investing in an asset, finding capital to invest in an asset, is to generate a return in profits and cash flow to pay back the investment and generate additional growth for the company. That's corporate finance 101. Okay. And the balance of working capital and long-term capital is how you achieve this capital. Remember, companies are run by two types of capital assets: short-term, cash, inventory, receivables, and long-term, buildings, computers, equipment, land. It's the mix of these long-term and short-term capital financing that provides for operations on short-term and long-term growth by investing in assets to produce a return. And that's what we're studying in these first couple weeks of our class. What is the definition of risk? And what is the definition of return in getting capital? But we can't start any of this conversation without understanding the present value of money. What is the value of money in the market? What is the value of a dollar today compared to the future? What is the dollar compared to the future to today? And now a lot of you have studied this before, and I'm going to go through this rather quickly. I have a short little video to show you about this, which kind of sums up everything. But remember, we're always looking at how assets grow into the future. The reason why we buy stock in Apple Computer, the reason why we lend somebody money and buy a bond, or the reason why we invest in a company is to get the value to increase over time. The future value is going to be greater than the present value. Also taking into account what's the future value compared to the present value when you take a look at inflation. If I'm going to earn 1% off an investment in the next year, why should I when the inflation rate is 4%? I'm losing money. So there's a lot of things you have to look at as far as return and the future value of money. That's very important. And to understand that concept, we're going to look at a couple examples in our spreadsheet. But first of all, let's take a look at this video explaining the time value of money.
So if you've taken any accounting courses or any basic finance courses, you've probably been exposed to something called the time value of money. So we hear this concept a lot, and it's something very important to the foundations of finance and to some degree accounting. So we want to talk about, well, what does this mean from a conceptual point of view? What is the concept here? What are we talking about when we say that money has a time value? So let's look at this through an example. So let's take an example here. Let's say that I offer you two options. Okay, now one of the options is going to be that I give you $100 cash today. $100 today. And then in the other option, we're going to say that I give you, let's change colors here again. Let's say I give you $100 1 year from now. 1 year from now. Now, let's just assume for a moment that when I say I'll give you the $100 1 year from now, that's certain. That's not something that I might not pay it or something like that. It's guaranteed. You either get $100 today or you get $100 1 year from now. But either way, there's no risk associated with it. You're going to get the $100. So let's look at these two options. Now, which would you prefer? Now, you might say, well, I just prefer the $100 today because I just want the money. I have something I'm already going to spend it on. But let's just forget about that for a moment. Let's assume that you don't necessarily have anything you want to buy, but you do want the $100. Well, you might think, well, I'm indifferent whether I get it today or whether it's 1 year from now. But let's think about this, because the money has a time value. Now let's illustrate this. So let's look at a little timeline here. So here in this option, we're getting the $100 right here, which we'll call this, that's today, right here. This is today. And then over here, this is 1 year from now. 1 year. Now let's go down to our other option, and we'll have a little timeline. And again, we've got right here is today, and you're not getting anything today. There's nothing here because you're getting it 1 year from now. You're going to be handed right here $100. Now let's think about things here for a moment. So when we get the $100 here today, what can we do with that money? Well, you could go out and spend it or something, but let's just assume that you didn't spend it. Well, what else could you do? You could invest that money. Now, let's say that you invested in something and you ended up getting a 5% return. Let's say you took it to the bank and you got a 5% return on some kind of investment. Now, what's going to happen is that at the end of that year, you don't have $100 anymore. Well, what do you have? You're going to have 100 times 1.05, which is going to be that's going to be $105. So we see that if you get the money today, if you get it sooner rather than later, there's a value to getting it earlier because it can be invested to earn a rate of return. And then at the end of the period, you end up having more money than what you started with. Now, when we look at the other option where you get $100 at the end of the year, you didn't have the option of investing it here because you didn't have the money. So when you get the money sooner rather than later, there's more value there because you can go ahead and invest the money and earn a return on it. So that's what we're talking about when people say that the time value of money. They're just basically saying that money is something that if you're looking at cash flows, cash flow today or cash flow in the future, a cash flow today, all else equal, the same amount is going to have more value because it can be invested for that return. So now you might be thinking, well, how does this have real world applications or what are we thinking about? But let's say we've got some project that the firm is thinking about. That project, you might say, okay, well, we're going to buy this machine and it would generate cash flows over a period of, let's say, 5 years. So you can look at these different years and you can go and say, okay, here's year 1, 2, 3, 4, 5. And you can say, okay, well, we estimate that in year 1, if we get this machine, we're gonna have $100 in cash flow. In year 2, 175. Year 3, 200. 300, and then let's say in the last year it generates 50. But what you can do is say, okay, well, now we know we're estimating these cash flows, but now what we want to do is we want to say, okay, well, like for example, here in year 5, that $50, we can't just add all these together and say, okay, well, now we've got this sum and this is how much it's gonna generate from this. We have to take into account that $50 5 years from now is not worth the same as $50 today. So what we're going to do is account for this time value of money and TV, maybe not the best acronym I have there, but the time value of money. We're going to look at this and we're going to say, well, what if we can just go ahead and say we earn a 5% interest on all our investments? Then we can say, okay, let's figure out what that $50 5 years from now is worth in terms of today's dollars. And when we do that, what we're doing is called discounting cash flows. So we're discounting cash flows. So that 50 here, this is a cash flow in year 5. And what we're doing is we're saying, what's the rate of return we could have earned on money today? Let's say 5%, 7%, whatever it is. And then let's use that to go ahead and discount this number and say, so it's going to be something less than 50 because maybe it's 30 or 35 or whatever, depending on your discount rate, could have been invested today to get 55 years from now. So when we talk about discounting cash flows, what we're doing is we're using the time value of money concept and some other formulas that we're going to talk about in other videos to take future cash flows and figure out what are they worth today.
Whenever people talk about investing, the terms risk and reward tend to come up a lot, and they usually tend to come up together, somehow implying that the more risk you take, the more reward that you might be able to get. And that's actually what it is implying. But what I want to do in this video is give a little bit of an introduction to that, or a little bit context, and a little bit more structure on how do you think about risk and reward. So let's say that we have $1,000. And we want to figure out what we can do with this $1,000. Well, one option is we could just put it into a savings account. So here is one option. So we could put it into a savings account. And in this situation, our reward, I'll start with a reward first, is we'll get, I don't know, 1% in interest per year. 1% annual interest. So after a year, we'll have roughly $1,010. We got 1% on our $1,000. So we get a little bit of reward. What's our risk? So the risk here, I'll write risk in a different color. What is the risk here? Well, if I'm putting it into a savings account, and assuming I'm putting it into an FDIC insured savings account, let me put that over here. If you do open a savings account, it should be FDIC insured. That means that it's being insured by the Federal Reserve, which means that if for whatever reason that bank were to fail below some limit, the Fed will insure your money. So even if this bank fails and it loses all of its money and everything, you'll still get your deposit back. So if you're investing or if you're putting money in an FDIC insured savings account, your risk is essentially zero. You are guaranteed to get that $1,000 back regardless of what happens to that bank. So you have very little risk there. But you might say, look, this is a good risk, but I feel like I can get more than 1% on my money. Let me think about the other places that I could invest it. Well, you could. And obviously, I'm not going to be exhaustive on all of the different investment options. I just want to give you a sense of risk and reward. You could say, well, maybe I could lend the money to a very reputable company. So let me say, lend money to reputable company. Reputable company. And maybe this company has, billions and billions of dollars in assets. It's been around for hundreds of years. It generates cash on a regular basis. There's really very few circumstances in which you could imagine that this company would not be able to pay off its debt. And you lend money to a reputable company by essentially buying their bonds. When you buy a company's bonds, you are lending money to that company. So that's just the way you should think about it. So the reward here, if you lend your money to this company, they will pay you 6% in annual interest on your $1,000. So 6% on the first 1,000 or the first year, you'd get $60. It's 6 times more than what you were getting in the savings account. What's the risk here? Well, it's not zero anymore. It's not FDIC insured. The Federal Reserve isn't saying that they'll either give the money if the bank goes out of business, or they'll print the money if they don't even have it. Here, the risk is that the business defaults on the loan. So the business defaults on the loan. So the company itself might go bankrupt. If it goes bankrupt, then all the people that the company owes money to will go after that company's assets. But maybe you are low on the pecking order. Maybe the company doesn't have enough assets to pay everyone back. So there is some risk. Any business could go out of business. You never know what might happen. But since this is a very reputable company, and as we said, it has a lot of assets, it has a very stable business, it does good in boom times and in recessions, this is a low risk of business default. So I'll write low risk right over here, because we're assuming it is a reputable company that has a lot of assets and all the rest. Now let's say that even that 6%, it's all right, but you feel like you could get more, you could do better. So let's say that you have a friend who is let's say that he's just starting his career as a doctor. So he has a nice stable job. So he's just starting his career as a doctor. So stable income. He's making $200,000. He's making $200,000 a year, but he's just out of medical school, and he figures he wants to buy a house. And so he's trying to find people. So he's just starting. He wants to find people who can help him with the down payment on the house. So here, your reward, and he says, anyone who's willing to lend to me, I will give them 8% annual interest on their money. Annual interest. and it looks pretty good. Stable income. It's only $1,000. He's not buying an outlandishly expensive house. He's buying a $200,000 house on which he wants to put $40,000 down payment. Seems well within his means to pay it, but there is always some risk. There is always some risk that he doesn't pay. Doesn't pay. I mean, who knows? Hopefully this doesn't happen. Maybe something happens to him himself. Maybe he's not able to work as a doctor. Maybe something happens to his health. Maybe he has some type of addictive personality and he likes to drink away all of his money, or he likes to gamble it away, and that's actually why he needs loans to begin with. So there is some risk. So there's a risk that he doesn't pay. But by all indications, he looks like a pretty safe character. But it's definitely riskier than this company because you have no assets to go after if he doesn't pay. Companies can't randomly get hit by a bus. A human being can. So companies for the most part cannot become alcoholics. A human can. Who knows? We don't know. But there are definitely more risks associated with this individual doctor who does not have assets you can go after. But maybe this is also not enough reward. You're like, I heard that I can do even better. I can do better than this in the stock market. So you look at another option. So let's say you invest in the market. Invest in the market. Invest in stock market. In stock market. And you're just going to invest in a bunch of, a broad portfolio, kind of investing in the market as a whole. The reward here would be the expected return of the market. So you look at historical results in the market and you say, look, it goes up and down every year, but over long periods of time, it looks like people, and this isn't the exact number, but it looks like people have averaged approximately 10% per year. So that looks pretty good. But what's the risk? Well, the risk is that this expectation is just based on what the historical returns in the market were. There are huge periods of time in the market. I'm talking 10, 20, 30 years where the market is flat, where the market could even go down. People could, in any given year, the market could go down in the double digits, or in the 30, 40%, even in really, really bad years. That we really don't, you really aren't sure whether you're going to get your 10% per year. So I would say the risk here is volatility. And volatility just means it could go up and down. It jumps up and down. It's not going to be a constant upward trend like your savings account will be. Volatility, and you have a good chance that you could actually lose the money that you're investing in. It could go down in any year, in any month, in any 5 years, in any 10 years. So once again, it seems like a kind of risky thing, and you can very easily lose everything. And let's say that even 10% isn't enough for you. You say, hey, I want to look at things that maybe I could get even a better return. So you have your brother-in-law who's been out of work for a little bit. So let me write the brother-in-law right over here. Your brother-in-law has been out of work for a little bit. And he says that all he needs to start his new guaranteed money-making scheme is $1,000 so he can buy the equipment so that he can start it up in his garage. And the reward, and there's multiple ways we could set up the reward. We could make it so that he borrows the money for you. We can make it so that you own part of the business. So let's say the reward is you get a 50% stake in the business. 50% stake in the business. And let's say that your brother-in-law is right, and this becomes a $1 million business. And it becomes a $1 million business. $1 million business. So this is a very, very, very high reward if what your brother-in-law is telling you is correct. But what's the risk? Well, the risk here is obviously that he's not correct and that he squanders all of your money. So lose everything. Lose everything. And not only could you lose the monetary money that you put in, it could also ruin your relationship with your brother-in-law and maybe your spouse. So risk relationships. Relationships. Maybe I should put you risk family. Family happiness. Once your brother-in-law loses all of your money, it won't be so easy at Thanksgiving anymore to have a civil conversation. So in general, the overlying, I probably did more of these scenarios than I needed to, but I think you see the general trend. The more risk that you take in general, the more of a reward you should expect to get. Or the more reward that you're expecting to get, there's probably some risk there. And if there's something that looks like it's really safe with really high reward, one of those two things are probably not true. So if we were to plot all of these, And I haven't really quantified, I haven't kind of given you a way of measuring risk. In future videos, we can think about that, and academics have thought about ways of measuring risk. So that's risk and reward if you plot it all over here. So the savings account, it's zero risk. So this is a savings account over here. It's zero risk, and your reward is 1%. So this is 1% right over here. The lending to a reputable company, it's a little bit higher risk. So this is this one right over here. It's a little bit higher risk, and your reward is 6%. So let's say this is 6% right over here. So it's a little bit higher risk. I'm just saying risk is increasing. If you lend to the doctor, so let me pick another color here that I haven't used. If you lend to the doctor, once again, the risk is a little bit higher than lending to that company or the savings account. Once again, a little bit higher reward. A little bit higher reward. You now have an 8% reward. Investing in the stock market. Let me pick a color I haven't used yet. Investing in the stock market. Once again, higher risk, but also higher reward, maybe 10% per year. That's 10% right over there. Your brother-in-law, super high risk, probably off the charts over here, but also super high reward. So maybe it might be like that. But the general idea is the more risk, the more reward.
People.
Okay, there's a couple of videos, and they're kind of boring, but I'm sorry. A couple of videos highlighting what the time value of money is and the relationship to present and future value, and also to risk and reward. We'll take a look at that documentation of understanding risk in the capital asset pricing model when we look at stocks next week. That is the efficient market hypothesis that's talked about in Chapter 6, which basically means in English, as what this video just saw that you had, the greater the risk, the higher the reward. It's a question of whether you're willing to take that risk, and are you allowed to take that risk in your present financial situation. So we'll look at that when it comes to stocks in our next week's video on Chapter 7. But in the meantime, let's go over a couple of key points of these videos and a couple of key points how it relates to our class. Remember, our class is called Corporate Finance. It's the strategies evolving around financial management decisions. And what's the overall financial management decision of a company? To maximize shareholder value. So we're kind of trying to do that with raising capital, with investing capital, with making the strategic decisions in the industry and the market that we have, in the surrounding economy that we're in. It makes your head spin. But here's a couple of key points. And our one of our videos in our first video talked about this. Here's a project that's costing $100,000. All right, and this is the cash flow we anticipate generating off that project over 10 years. Why 10 years? That's the depreciable life of that asset. Remember depreciation from your accounting days? Depreciation is allowed to you by accounting rules, and the IRS allows you to depreciate that asset over time. That determines your financial life. You might own that asset for 30 years, but its depreciable life is 10. Thus, the financial life is 10. So here we're making an investment at $100,000, and it's going to generate $140,000 in cash flow. That's profits and cash flow over 10 years, $140,000 on a $100,000 investment. The cost of the money to get this $100,000 is costing us 4%. Either we're borrowing it from a bank, or maybe we're taking it out of our retained earnings and taking it away out of our profits and our cash and investing it. The 4% represent what we're giving up by taking it out of our cash and our profits. So 4% is our cost of money. So if I take this future cash flows going out 10 years, and what we call discounting them back to today, year zero, at 4%, I use a formula. It's called the NPV formula. And I'll show you here, right here. If I go to formulas, function in my spreadsheet, and go to the function for financial right here, this is the financial functions. They're built into every spreadsheet, Apple numbers, Excel, Google Docs, whatever. And I look for the function net present value. In other words, it's taking the net of many years of cash flow, NPV. If I take that and I put in my interest rate or my cost of money, 4%, and a lot of you probably have already done this in other classes. Hopefully you have. And you go to the value section. In the value section, you just paint from year 1 to year 10. All right. from year 1 to year 10. And if I hit okay, it gives me $108,427.28. In other words, this $140,000 discounted back to today at our cost of capital of 4% is $108,427.28. So this investment compared the amount of return in today's dollars compared to the investment is giving us a profit margin of $8,427.28. That's pretty good. So it's profitable. We're actually making $140,000, but taking that in terms of today, the present value is $108,427.28 discounted at what that money is costing us, 4%. And this is used all the time in finance. When the University of Laverne decided to build a new housing and dining hall, they determined what it would cost, and then they determined how much money they would charge students over time, over the depreciable life, what happens to be 15 years. And then they discounted that back at what it cost them to get the money for the financing. And they determined that was a positive present value. So if everything holds true in their projections, that's a good investment. The key to this, though, it's projections. And that's why MBA graduates get a lot of money if they can make sure that they do these estimates and these projections accurately. And that's the concept of the future value versus the present value. The future value is, well, we're going to generate $140,000 off this investment. The present value is bringing this flow of money back to today at an interest rate that's our cost of capital. And what compare that to the investment of the cost of the investment of $100,000, and we're making money. We're going to be doing this in numerous occasions throughout our course, and you're going to be doing it as a team in the electrics case. Very important. So this is a concept that we need to make sure we know how to calculate, and I'll be giving you a lot of templates on this, but this is the first one, and you should keep it. It's showing you discounted cash flow. And we apply these figures also to the valuation of bonds. Chapter 5. What is a bond? A bond is in dollar denominations of $1,000. Most bonds are sold in $1,000 denominations. If you walk into Wells Fargo tomorrow morning and say, hey, I'd like to buy a United States Treasury 10-year bond. And they'll go, okay, you got $1,000? It's $1,000? Yes, it's $1,000. Oh, okay, well, I'll come back the next day. And then you go back the next day, here's $1,000, buy me a bond, okay? So most bonds, both corporate and government, are in $1,000 denominations. Now, some treasury notes like US savings bonds and that sort of thing, you can buy in many denominations. But the major form of bond or credit financing is in $1,000 denominations. That's called the face value. The coupon rate is the interest rate that the company or institutions that's borrowing that money has to pay you on an either semi-annual or annual basis. All right. So in this case, the bond here, I don't know what time period it's in, but it's not today. But if you lend Renfro Rentals $1,000 at 10%, Renfro Rentals must not have very good credit. They're paying you very high interest, risk and reward. That means they're going to pay you $100 a year in interest on that debt. The debt is due, the maturity is in 8 years. So every year for 8 years, you're going to get $100, and then they're going to pay it to you semi-annually. In other words, $50 every 6 months. So $50 every 6 months, which is 5% per period, you're going to get a check from Renfro Rentals. And at the end of 8 years, you're going to get $1,000. All right. So that's a little bit, that's pretty good, really, when you think about it. Geez, I'm making 10% on my money, and I'm going to get my $1,000 back in 8 years, and I'm making $100 a year. That's $800 over 8 years. Plus, I get the $1,000. That's $1,800 of cash flow over the next 8 years. That's a bond investment. And the good thing about that is it's guaranteed. If Renfro can't make an interest payment, they default. And then they have to sell assets which were used as collateral to finance that loan as backup. And then they'll sell those assets and you're still going to get your money. So it's not a bad investment. Are you guaranteed return when you buy a stock? Nope. But you're guaranteed a return when you buy a bond. And that's why some investors and many investors like bonds. You know what you're getting up front. If tomorrow morning I go on Robinhood and I buy 10 shares of Ford Motor Company, which is currently trading about what, $15, $12 a share, that means I'm going to spend $1,200, all right, $1,200 on something that I don't know if I'm going to get paid back or not. Here, I can pay $1,000 and I know exactly I'm getting $100 a year and I'm going to get my money back in 8 years. That's why a lot of people buy bonds, because it's, you know, right up front in year zero what you're getting. And that's why a lot of companies issue bonds, because investors trust the bond way of raising capital for companies. It's a huge area. Now, what happens if my 8-year $1,000 bond, I decide to sell it? Okay, and I decide to sell it. But I sell it in a market that's now yielding to maturity to 8.5%. In other words, let's say after a while, I decide to sell this bond, okay? All right, let's make it after 2 years, okay? So after 2 years, I decide to sell this bond. So that means there's 6 years remaining, all right? 6 years remaining. What would be the value of this bond in the market if I go to the market and I call up my stockbroker or my investment manager and say, okay, it's been 2 years. I've gotten $200 in coupon payments, but I need this $1,000 back now. I can't wait another 6 years for the maturity. I need the money now. I have a kid going to college. I got to cash in this bond to help me pay for it. Well, your broker is going to say you're going to be a little disappointed here, because in the market over the last 2 years, the yield on this bond has gone from 10%, which was the issuing coupon, to 8.5%, or in other words, 4.25% per period. That's half of 8.5. So if I decide to sell the bond in the market, I'm going to have to determine its present value today in the market with 6 years remaining. This is, again, the concept of present value. So I would go to formulas, function, financial, present value. What is the present value of this bond today in the market? Well, the interest rate today is 4.25%. The number of periods remain are 12. Wait a minute, Mr. House, you just said 6 years. Yeah, 2 periods per year. That's 6, that's 12. The payment, well, I'm getting right now $50 a payment. And the future value is still $1,000, right? Interest rates have gone down compared to the coupon rate. I determine that. Whoa, thank you. $1,069.38. The interest rates have dropped in the market. My bond has become more valuable. So what's my broker talking about? I'll be disappointed. I'm not disappointed. I made $200 in 2 years, plus now I'm going to get $1,069 back on my investment of $100. That's pretty good. Well, the main reason that happened is because why? Interest rates have fallen. Over the last 10 years, interest rates have been very low. Bond values have gone up extremely high because interest rates are lower than the coupon. So why would I want, if somebody wants to buy this bond in the market today to get these 10% payments, they're going to have to pay at what is called a premium. And that's when the face value is greater, the bond's value is greater than the face value. And the same thing holds true if interest rates go up to 12% and there's 6 years remaining. That's 6% per period. What is this bond's value now if I decide to sell it? Formula, function, financial, present value. Now the market is 6% per period. There's still 12 periods left, 6 years. The payment is still $50. That's the original bond. I'm going to get my $1,000 back, but look what happened. And the value has gone down. The value has gone down to $916.16. Why? Interest rates have gone up. Yield to maturities have gone up over the coupon rate. So why would I want that type of value now? Because I can get my $100. Interest rates have gone up, the bond value has gone down. So it's very expensive and I've lost money. Why would I want to pay $916 to get a 10% bond when I can buy a 12% bond today? I might as well just buy a new bond today and get $120. Why would I want $100 when I can get $120? So this bond, this older bond, this existing bond has gone down in value. And that's the reason why I show this example of Renfro Rentals is this is why money changes value and assets change value when interest rates change. A lot of people today are talking about interest rates. Interest rates are going up. That makes the existing assets lose value. And that causes a problem. So that's one of the things we need to remember going forward in our critical thinking about strategies is how interest rates, present values, future values play in the market. Here's another tab. Okay, it's called beta. This is talked a lot about in chapter 6 and in these chapters. What is beta? It's risk. It's a standard deviation regression analysis in statistics terms of determining the value of a risk and reward, beta. The standard beta average for a market is 1. The beta for a risk-free interest rate, the United States Treasury yield, which is called risk-free credit, is 0. What is your company's beta? This is one of the things I'm going to have you find in case number 1 this coming week, posted on Sunday. Find the beta of your corporation and determine what they would get as their cost of money. For example, this is called the capital asset pricing model. The risk-free rate is 4% with a 0 beta. The expected market return in the market is 12%. That's a beta of 1. My company's beta is 0.8, which is right between 0 risk and average risk, 0.8. So our company's pretty good. What is the expected return on this company's beta? It's 10.4%, much greater than the risk-free, but lower than the market return because our beta is lower than them. This is that formula. And if you can see it in this cell, it's the risk-free rate times the market premium. And the market premium is the market rate minus the risk-free rate. And that amount is multiplied times the beta of the company. So in other words, it's the risk-free rate, 4%, 4% plus the market premium, which is 12% market return minus the risk-free rate, which is 8%. And that 8% is times 0.80, which is our company's beta. So that's 4% plus 6.4%. And that equals 10.4%. That's the capital asset pricing model. It combines the risk in the market, 0 risk of the United States Treasury yield, market risk, the standard return of the S&P 500 or any market indicator, and it puts that into the context of the risk of the specific company. In this case, the AA Corporation is 0.8. Put all those together. If I was an investor and wanted to invest in AA Corporation, I'm going to need a 10.4% based on the company's risk related to the market today. Risk and reward. Lower risk, 10.4%. Average risk, 12%. 0 risk, 4%. Where do I want to invest in today in the market? If I want to invest in AA Corporation, I should expect a 10.4% return on my investment every year. Is that going to happen? No, it's not guaranteed. But based on current market indicators, that's what's happening. This is a key part of Chapter 6, Risk and Reward. This is also called the efficient market hypothesis, the capital asset pricing model. You need to know this. This is going to be a key in part of case number 1. You're going to find this number based on the numbers I give you for your company, but you're going to have to find the beta of your company that you selected. And we'll talk about more about that in our introduction video to case number 1 this coming Sunday, September 5th. And sorry you have to work a little bit over Labor Day weekend. I apologize, but such is life. All right, so this is an introduction based on risk and reward, financial modeling, as present value and future value, and the definition of a bond. Chapters 4, 5, and 6. Next week, we'll concentrate on stocks, which is a little bit larger discussion because there's more involved with stocks, because remember, stocks, you're not guaranteed anything. Where bonds, you know exactly what you're getting in advance, so everything's predetermined in many cases. With a stock, it's a little bit more complicated as far as the reward. And why we're spending time on this in the first few weeks of our course, because when we get into our critical thinking and beginning in chapter 4 and week 4, we need to know these basics to make our strategies going forward in investing in capital and acquiring capital for corporate value. So we'll talk more about that next week. So that's our lecture video for this week number 6. Sorry, it's week number 2. Sorry, it's a little bit late. Any questions? I'm around all weekend for any questions or concerns. Think about working with a team or a group. If you don't want to worry about that, I will pick the team that you're on. Have a great rest of the week. Have a great Labor Day weekend, and I'll see you on Sunday in our next video. Adios, everybody.